Thank you very much for coming to hear what we've got to say this morning. I'm going to start with something that I may have said to some of you before, but I think it's worth reiterating. And the initial point I wanted to make is that the Hunter is not an island. It's not the Republic of the Hunter, and unfortunately there's no drawbridge at the Hawkesbury River. I know some of you would like there to be a drawbridge that's, we just drop down when we need to get things. But unfortunately, the reality is that the regional economy is very much part of the broader national economy, and very much because of that beholden to what is going on in the international context and the national context. Now, my role here today is not to give you definitive answers on what's going on in the international and national economy. I'm going to leave that to Carsten, so he can tell you that. But my role here today is to try and explain to you how things are translating into the regional economy, and how the regional economy is potentially going to react, depending on different scenarios that may prevail through 2012. Hence the regional outlook in a volatile world. As I say, the first thing I want to be a little bit abstract here. The first thing I wanted to say is that, as I say, we're beholden to exogenous factors, external factors to the region in many ways at the moment. And I'm not going to go into a lot of detail about these things because I'll leave most of it to Carsten, but I wanted to touch on three, which I think if you're really going to understand what's going on in the regional economy at the moment, and you're going to understand how things are shaping going into this 2012 and likely to go into 2012, you have to understand at least three major things, three major external influences upon the economy. The first one, of course, is Asian resources demand. Now, we know this is the most obvious one, excuse me, because of the cold activity that we're seeing and the infrastructure activity around the port and the rail lines and so on and so forth. This is, from the direct effects, this is pretty obvious. But you have to consider that in terms of the indirect effects as well. Now, I won't get into too much detail about the terms of trade, but you need to understand that the terms of trade effectively reflects that we're getting much more money for selling our commodities and exports overseas, simplistically, and our imports, in terms of our flat TV screens and so on and so forth, the manufactured goods that we bring into the country is getting cheaper and cheaper. And what effectively this means is we're getting a huge income stimulus to the national economy off the back of this. The Reserve Bank are quite conscious of this, which is why they were raising rates not too long ago. But the other factor that comes with the resources boom that we're having and the terms of trade boom that we're having is that this is the first time we've had a resources boom of this magnitude that goes with a floating exchange rate. And what we've seen is as the terms of trade has risen up and the economic prospects of the region, well, the national economy and the region going with it, has shot up, the Australian dollar has shot up with it. And of course, because we're getting this growth from resources and this exceptional growth from resources, we've had interest rates higher than we otherwise may have had them because of that boom. Now, of course, they create some serious challenges for other parts of the economy, and you need to understand that, and I'll discuss how that's flowing through the regional economy going forward. The other one that you need to get your head around, obviously, is, I'm sure you read on the news and so on, is the sovereign and international banks' debt challenges. I'm not going to go into detail again with this, Carsten can touch on this, but one of the things that you need to be conscious of is that everybody's competing to be able to export into the global market at the moment. So everybody effectively on a global place is trying to keep their currency low, and they're doing whatever they can to do that. That, of course, means that their exports are competitive and they can keep their employment going, because things are very dire in parts of the world. They're doing whatever they can. And, of course, what this means is that keeping the dollar artificially high again, and that has implications for us. And the other side, of course, is uncertainty. With the uncertainty about what's going on in the global world, the global economy, where are we going to be in 3 months' time, 6 months' time? Every time the news gets worse, and then it gets better, and then it gets worse again. How's that going to impact on us? Are we going to get a GFC2? Are we not going to get a GFC2? Carsten is going to tell us in great detail whether we are or not. But that uncertainty obviously prevails and translates through what's going on in the regional economy in various different ways. And the last one is domestic debt deleveraging. Obviously, when we deregulated the financial markets in the 80s, after a while, people got comfortable that inflation was under control and they started borrowing. Now, this happened in the household sector and the business sector. And we've been borrowing and borrowing and borrowing for a period of time where we really got ourselves to a structural position where we had extensive debt. Now, when you look at where we're at from a public sector debt point of view globally, we're one of the best countries in the world. They've got major problems and we're not in that situation. But when you look at the private debt in terms of households and businesses, we're right up there in terms of the debt that we're carrying because of that long wave of borrowing. Now, of course, that was a major stimulus to economic growth in the periods that we were borrowing. So we borrowed and we spent some of it and we saved, and some of it went into asset values and boosted up asset values. But now we're in a period where, because of the global concerns, we're effectively paying that back down, and we're sort of, looking in different ways. We've either got a hangover from the part that we've had, or effectively we just kind of get ourselves into a more sustainable position going forward, and we're utilising the resources boom in a good way in respect to pay down that debt and try and get ourselves into a more sustainable long-term position as far as that's concerned. But you need to be conscious of that in terms of how things are translating through the regional economy. So some of those things give substantial stimulus. Some of them are substantial headwinds, and depending on where you are in the economy, you're being buffeted around by those different forces. So I'm going to cut straight to the summary as I do, and then I'll try to work through the details and explain how I came to this summary. So we went from 6 months ago from a managed slowdown where the Reserve Bank was trying to make sure we didn't get too hot post-global financial crisis to potentially a bit too much cooling, hence the interest rate cuts that we've had recently. This is a milder case within our region, but we're definitely seeing this coming through. We still have major momentum in resources and supportive infrastructure. That hasn't gone anywhere, it's still there, and I'll discuss how illustrate the momentum of that through the global financial crisis, number one. But there's definitely more evidence now that the economic headwinds are taking a toll on parts of regional manufacturing, tourism, retail, construction. We're seeing these signs of strains coming through for sure. Looking forward, how do you analyse things looking forward in such a volatile context? I've just taken the position of, okay, well, if we don't get another financial contagion crisis going on, and if we do. So if we don't, we're going to get subtle interest rate policy coming through. That'll try and underpin retail and housing, and it'll try and make sure it doesn't fall away too much whilst they're trying to manage the strong growth in resources. But at the same time, the Reserve Bank won't stop the headwinds really engendering structural change in other sectors. And if you look at what the Reserve Bank says over time, then they would argue that they're not there to try and stop structural change. And what that fundamentally means is if we're having a resources boom and expansion and mining going on here, other parts of the economy that we're not so competitive in and we don't have the same competitive advantage are going to have to be whittled away. And effectively, that's manufacturing when it comes down to it, and some other parts of the economy. So, but if we do have a global financial crisis, things change quite dramatically, obviously. So, resources investment won't go away, but it will stall, it will slow down. We've got obviously a very nice precedent of a couple of years ago to give us an understanding of what may happen there. And we get falls in the dollar, which would take pressure off those sectors that are exposed to the dollar. And we'd obviously get massive fiscal and monetary stimulus the same way that we did before that would boost or help at least underpin retail and housing and those kind of domestic sectors. So that would change the economic structure. So depending on what your preference is there, you can decide which way things might go. And one of the point, you can be prepared if things go certain different ways. You can understand that how that translates through the region will differ accordingly. Okay, this is the structure I'm going to go through. The labour market gives us great tight data in the region, but it's a bit more historical. That gives us the context of where we're at. Then we'll look at the different components of economic growth in terms of business investment, commodities, household consumption and housing investment with a view to how those things are looking and shaping where we're going, and then we'll pull that back into the outlook. So the labour market. The managed slowdown, okay, so we peaked about just between 320 and 330,000 employee total employment. That's full and part-time employment just added together, and that's fallen away by about 3%. So you can see we've had a moderation in intended managed slowdown, but as I say, what they're concerned about is that accelerating a bit more than they wanted it to be. The unemployment rate has been pretty tight. We're at 3.5%, I think the last rate was for the region, which is exceptionally tight. That bounces around a little bit because of the survey methodology they use. But fundamentally, unemployment in the region has been between low 4s, 4 to 5. And that's, in the last 6 months of last year, was pretty much the same as the year before, actually slightly tighter. But we know that the labour market is getting a bit, the demand for labour has fallen away a bit because of the participation rate as well. So this is the participation rate which reflects those that are engaged in the labour market, either unemployed or employed, as a proportion of those that could be in the labour market, the civilian workforce. And it shows that basically discouraged workers, if they're not needed at the retail shop, for example, they're just going home. They're not registering for unemployment. They're just giving it a break for a while and hoping it turns around and they'll get back into the labour market. So that's the weakness. The difference between, this is the global financial crisis equivalent. We had a similar fall, slightly more dramatic fall with the global financial crisis and the participation rate, where discouraged workers left, but at the same time we had unemployment going up as well. So we're not in the same dramatic position as we were there, but it's definitely a softening off in the regional economy. I put GFC1 there to show you when things start, and you'll see that through the charts, just in terms of giving you an illustration of, okay, well, this is what happened with GFC1 within the region, and if we had another kind of major event in that kind of way, then maybe this is the kind of impact that we could expect going through. I put it there when the first bankruptcy came through in the Midwest American mortgage belt, but in reality it didn't bite into Australia until late 2007, 2008, as you'll see from the charts going through. So just looking forward in the labour market, this is annual change in job advertisements. So this is the crisis, everybody contracting, reducing their demand for labour. This is the recovery from the global financial crisis. And of course, since then, we've just been eroding. And what the latest data shows is basically this slowdown is going to progress for at least the next, gives us a leading indicator of 1 or 2 quarters. And we can expect that's going to continue in the labour market. Looking at it spatially, last time I presented, I gave you an illustration of this particular map, mainly to show you how strong things were in the upper Hunter. It was all dark black up here until I was showing the unemployment rate last time. And basically, we had virtually full employment in the upper Hunter just because of the phenomenal growth in resources and resource-related activity. This chart is sort of an evolution upon that. And what it shows you is the change in the number of unemployed by SLA, a small local area. Now, dark areas are bad, pale areas are good, fundamentally, in this respect. So what you can see through here in the upper Hunter, the reason why they don't look fantastic is because they've got full employment. They can't reduce their unemployment, they can't keep falling away. Some of the numbers here are statistically not significant anyway. Sort of Dungog went up by about 6 unemployed people. It's neither here nor there. Fundamentally, the story it's telling you there is they've got full employment in their labour market. What we are seeing in terms of the pale areas is that the people on the fringe of that are being sucked into that labour market. So around Maitland, Cessnock, etc., as you would expect, we're seeing the evidence coming through that people are being drawn into that labour market and the strength of economic activity there. The other major point, though, really is where the dark spots are, and this is partly what tells the story. It tells the story here in terms of, for our friends down the road on the Central Coast. Unemployment is going in the wrong direction at a rapid rate down there. And that's fundamentally because they don't have the diversified economy that we have, and more to the point, within their economy, they don't have exposure to the elements of the economy that are strong. They have exposure to the elements of the economy that aren't really suffering the headwinds fundamentally. And this tells a story not only for the Central Coast, but for elements of the Hunter. That doesn't mean that doesn't exist here in the Hunter, it's just masked by the other elements of the growth. So that sits in here within a sectoral sense, but it's just being overridden at the moment by the stronger elements of the economy. So, turning to the different components of regional economic growth, business investment, commodities. First of all, commodities. This particular chart here, well, I mean, I'm only going to give you 2 stats in this respect. Mining employment went up in the 12 months to November, which is the last data we had for this respect, by about 32% of people employed in mines. And we're talking about a capital-intensive industry here, so 32% growth in a year is phenomenal growth. And this particular chart here shows you coal exports out of the port. And as you can see, this is a record level for the port in terms of thermal coal exports. This isn't all the coal that's produced. Obviously, not all of it goes out to export, but it just shows you the momentum that's coming through here. The other major point from this, of course, is GFC. GFC hit, it was drama, it was the end of the world for a period there, of course. If you remember, take yourself back to that. You see, we knew that it meant that things that were green light in the mining sense went to a kind of, oh, let's have a look at it and just check. We know that thermal coal prices, for example, went from a boom of between 140 and 150 down to between 70 and 80, dramatic kind of 40%, 50% falls. Fundamentally, the momentum of Asian demand hasn't made any difference. It put a bit of a delay, if anything, in there. But when you're talking about structural demand in this respect, it isn't going to waver, in it, as you can see here. And it's unlikely to waver going forward. So if those kind of thing, if we do get another container, it's likely to put a delay in again, but it's unlikely to really substantially rock the boat in terms of removing that as an economic driver for the region. Looking to other elements though, this particular chart shows you commercial vehicle registrations just as an illustration of business investment, capital expenditure investment within the region. As you can see, long-term growth obviously with employment, and just as the economy expands, you'd expect it to grow over time in terms of capital investment. But it's reasonably strong here. It's okay. There's no signs of weakness. But this is an illustration of the charts where fundamentally, if you can get your truck or your computer or your laptop, the benefits of the high Australian dollar and the terms of trade are that they are getting cheaper and cheaper. So what you can get a laptop for now, as you guys will know, in terms of the power and the price you've got to pay, is so much better than it was even a few years ago. So we're getting huge stimulus and benefit from that. And if you're buying capital equipment and so on, then that's a real benefit and a boost for the region. Of course, the inverse of that is the corollary of that is the guys who are suffering from the high terms of trade in the Australian dollar. So the most obvious of which is manufacturing. Now, we've had a lot of this in the press most recently, obviously, with the car manufacturing industry in Adelaide and Melbourne, closing down elements or at least slowing down elements of their business. We've seen this more and more, obviously, in terms of the recent stuff with the aluminium steelworks down in Victoria. And we shouldn't be in denial about the fact that this creates serious challenges for our manufacturing industry. Parts of our manufacturing industry are associated with the resources side, and they're really flying. And if you're producing equipment that goes into the mines, this kind of thing, if you're producing conveyor belts, presumably your world is flying. On the other side of the equation, if you're a metal manufacturer that doesn't have exposure to that kind of thing, then times are really pretty tough. And just because they're happening in the news elsewhere, we shouldn't be ignorant of the fact that the reality is parts of our economy are very exposed to the same threats and have some very serious challenges going through this year. Manufacturing employment last year fell by, in the year to November, fell after a few years of strong growth, I must say, but it fell by 13% as an illustration of that. Just wanted to touch back on the debt context again. This is one chart. There's more in the publication, but this one shows you the growth in business credits. This is nationally, because obviously, unfortunately, we can't get data for the region in this respect. But this peak here was the debt splurge, where we borrowed and borrowed, and the banks were happy to lend it to us. Prior to this is when the households were really borrowing and going up through here. They sort of levelled off in 2003 when the housing market settled down. But then business took up that credit for M&A and investment and so on and so forth. And then, of course, the global financial crisis hit, and it's kind of uncertainty prevailed. Goodness, we've got a huge amount of debt, and the private sector debt fundamentally means that people are much wary and they're effectively trying to pay that back. And that's a bit of the context that sets for business investment going forward. Obviously, people aren't borrowing and spending some of that money in terms of capital investment or what else, or asset values or whatever they're buying. They're effectively doing the reverse. They're deleveraging, and that effectively means that there's less money out there stimulating the economy in various different ways. Now, this particular chart shows you the construction context. So this is non-residential building approvals over time. This obviously is a leading indicator for commercial construction activity. So you can see here these blue ones are the public investment. This is the federal and state infrastructure stimulus off the back of the GFC response. But as you can see, as that's waned, the private sector just hasn't picked up to fill that gap. Now, interest rate cuts that we just had will help that a little bit, but effectively you're talking at the margin here. Part of the reason why that is so difficult is because people are deleveraging. There's no tenants out there or occupiers are really expanding and wanting to get into new space. There's constraints in that kind of way. Asset values have still got that debt deleveraging kind of value that makes it very hard to make things viable and stack up. And fundamentally, it's a very difficult world for construction at the moment. And we saw that yesterday, actually, when Dell and Rigby, which is a big Sydney construction company, basically closed down and lost about 500 jobs, disappeared. So times are tough for commercial construction guys in this region. And in the short term, those headwinds, unless they really start stimulating more rate cuts, those headwinds are still going to make it tough looking into the next year. So this is our part of our sentiment series in terms of we obviously do a survey every quarter of the business community and their expectations for a range of different things and their performance in a range of different ways. I've just put one of them up here for you this morning. This is business expectations regarding the Hunter outlook in terms of 3 months forward and 12 months forward. And what you can see is post-GFC, GFC rebounded from the GFC, and basically as those headwinds have started to take toll, sort of whittled away at people's perspective going forward. The little bit of good news is the latest figure, December's figure, shows that the interest rate cuts did have a bit of an effect. It did give people a bit of a boost, that we did have some ammunition that we could bring to bear, and basically maybe things were going to get better. It definitely helps, any bit of spare cash helps a business, of course, And so there is a bit of ammunition that the Reserve Bank can bring, and so that did boost confidence a little bit in terms of the outlook, but it didn't fundamentally change it. The other point I wanted to make from this chart, of course, is that whilst these kind of things are a good guide for where we're at now and where they may go in the short term, they were just here just before the global financial crisis as well. So be aware that those external factors can come in and swamp this right out of the way, just wash it out of the way and overrun it, basically. So if we did get another financial contagion, then the chances are that we'd have a similar kind of response, and we'd be reacting to it, and we'd be looking for this indicator to show when we're coming from it, etc., and how bad it's got. But in terms of the short term, it gives you a good indicator of where we're at now without a crisis, but a major external event like that could fundamentally change the context. So look, turning to household consumption. This again is a debt chart effectively. So this is the household savings ratio for Australia. I'll stick this up every now and then because it's just worth remembering in terms of debt. So this is the 80s, pre-deregulation of the financial markets and people borrowing. And we were effectively, this is a trade-off between household income and what we're spending nationally as a proportion of that, and this is the gap that's left. And this is what we used to save. Basically, we're saving less and less and less, effectively spending more and more and more of the household income across the nation. This is when we were having the housing boom coming in through here. This started ending. The party started ending with the housing market in late 2003, early 2004. But then, of course, the global financial crisis has brought this on even more. So basically, people are saving. They're putting more and more money away, and they're debt deleveraging their household balance sheet, which in a way is not a bad thing, that we're making most of the good times to pay that down. But of course, that creates a real issue for those guys who are in retail and consumption-related industry. And that context, you have to understand that context to understand what's going on there. So this is new passenger vehicle registrations over time. This is an illustration of obviously sales and people's desire to go out there and make major purchases within the region. As you can see here, good times, spending money, global financial crisis. Oh, I'm very worried about the amount of debt I've got. I'm not going to go out and buy that new car. I'm much more resistant to it. Now the confidence has come back a little bit because the cars have got cheaper and cheaper, and it keeps calling you up and saying, it's getting cheaper, you really want to buy it? But fundamentally, it's not in the same context as it was here. So this is an illustration of that reserve. So we've got a trade-off here going on, a clash of the different forces there in terms of the terms of trade. We've got more money in our pocket, things getting cheaper because of the Australian dollar in terms of imported goods, imported cars in particular, in this case. But the trade-off against that is that we've got much higher debt, we're much more conscious of it, and every time there's a bad news story, we go, oh, maybe I won't go and buy it. And so there's a trade-off and a clash of those, and it makes the regional context for these kind of guys much more volatile fundamentally. We obviously also survey the household every quarter, and we ask them their propensity to go out and buy major pieces of expenditure is one of the things that we ask them. So this gives you an illustration of their propensity to buy a motor vehicle or a household appliance or furniture. And as you can see, it's pretty patchy. I've just put December quarter up here, so because it's quite seasonal, so you can compare like for like in that respect. And these are the past 5 years, the latest one being the darkest one being December quarter last year. As you can see, it's pretty patchy really for motor vehicles. It's not like it's going to take off overnight. Household appliances up and down, depending on whether people are getting a good deal. Furniture is soft, if anything, off the back, I think, of that debt deleveraging context where people have already bought some shiny furniture, and do they need to go out and buy some more? Then people are more likely to be paying down their debt at the moment. Of course, this is proportional. Some people are, but fundamentally, people are more wary. So it's all patchy and or a bit soft, with the exception, of course, of holidays. This is 5 years progressive growth, and it hasn't waned. Now, the major reason, of course, for this is you try and break this down in terms of why this is happening, and one of the most clear indicators of why this is happening is unfortunately, we don't have these numbers for the region, but in terms of short-term departures from Australia, they're progressively rising. They rose 8% last year. Effectively, the dollar is too good an opportunity, a high dollar. Let's go overseas. Instead of going to the Gold Coast, instead of, if you're in Sydney, going to the Hunter, let's go over to Orlando, let's go to Hawaii, that kind of story. So people are effectively going overseas more and more. It's interesting because it's not so much actually that people aren't arriving. You'd think the dollar would be putting people off, and we're having a bit of volatility in that respect. People don't seem to be not coming to Australia because it's more expensive, but they have actually come back in reasonable numbers. But what we're seeing is the main driver of this is really that Australians not spending their tourism money locally, but making the most of the dollar and going overseas. And of course, within the region, that's translating not so much with us holidaying locally, obviously, but in terms of the local market, the Australian market doing the same thing, particularly Sydney. And you see here, this is change in tourism takings in terms of revenue, annual change, and you see it's very, very patchy. It fell about 3% in the year to September. And so that's translating through in terms of regional economic activity and tourism. It's not the end of the world, but at the same time, it's not stable growth that we'd like to see for the tourism industry. Again, this is our consumer confidence series in terms of the households or the residents' perception of the economic outlook going forward, the economy in 3 months and 12 months. And you see, again, similar story to the business, you know, and GFC, end of the world, rebound, thank goodness for that. Waning away, oh, maybe it's not as good as I thought, oh, I'm a bit worried about my job in construction, so on and so forth. And it was getting pretty soft, and this is why, on a national basis, the Reserve Bank cut rates, because things were basically tilting in the wrong direction by some major employers in the section, in the economy. But of course, that little boost there is the latest figure that we got there, and it shows that, you know, at least the Reserve Bank cutting its rates does have the capacity to stimulate. There's a close relationship between consumer confidence and retail spending, for example. So for retailers, this is a little bit of a positive sign. It shows that the Reserve Bank does have a bit of ammunition, and they can bring it to bear in terms of people going out and spending a bit of money and keeping those sectors going. But again, same story of the business context. It was looking okay just before GFC1. So if we get a major crisis globally, then sort of all bets are off in this respect. It gives us a short-term outlook of where we're going and how it's tracking, but that drama could ensue if something dramatic happened overseas. Okay, last of all, turning to housing investment. Housing investment, of course, doesn't just refer to housing construction, but any kind of investment, plumbing, etc., into dwellings and the whole dwelling. It's the biggest asset base we've got in the whole of Australia, trillions of dollars in homes, of course, and so it's a major economic factor. This is the housing market, so we're talking about red bars here are sales volumes, and the black line is median prices. The housing market's turning over okay. It's definitely not, you know, crisis kind of situations. This is boom situations. This is kind of not so good situation. This is kind of ticking over okay in the residential market. This is for the Lower Hunter, which is effectively Metropolitan Newcastle. But as you can see, the most significant part of this chart for me is really this bit, ironically, because this is the bit where we're borrowing all the money and effectively boosting up the housing market. And effectively borrow, pumped up the prices until we got to the point where we didn't want to do that anymore. Actually, the Reserve Bank started raising interest rates just here because of the resources. They were wary of the resources boom starting to come through. And that killed off the housing market here and nationally as well. And basically it's been flatlining. We got the stimulus following the crisis, which effectively picked us up a little bit there, but removal of the stimulus has meant that the housing market's gone flatlining again, going nowhere. At the moment, it fell about 2-3%. Oh, so, yeah, just under 2%, I think. But if you include inflation, we're going backwards slowly, about, you know, somewhere around 5% in terms of the housing market. It's going nowhere at the moment. And the big story with that, of course, is this debt story. People are paying back debt, and they're more reticent to be borrowing big money, and effectively, you know, from an affordability point of view, whilst interest rate cuts do benefit affordability and make it a little more balanced, people are just wary about borrowing too much, and effectively the housing market will carry on doing this unless we get a fundamental change in stimulus. As I say, they're flatlining. This is a series that we ask in terms of people's propensity to be buying a home. As you can see here, this is the boom of the market. Fell away with interest rate rises, global financial crisis, recovery because of massive stimulus there. But the interesting part of that is really that it's going nowhere fast. Even though we had 50 basis point cut late last year, people's that wasn't enough to get people excited about, oh yeah, I must go out and buy a home now. So fundamentally, if you think about where we had a bit of an upturn here, where the market, you know, at least prices rose about 7% and activity picked up a little bit with a response to the global financial crisis, that was in response to 400 basis point cuts in interest rates. That's a massive stimulus, was enough to drive the housing market and get it to pick up a little bit. At the moment, we've had 50 basis points. So it's not really scratching the surface in terms of turning around the context for that market. When we look at housing construction, this is just detached house approvals, of course, which are a leading indicator of construction activity. And I've just given you the New South Wales trend there in respect to that's all dwellings. all private dwellings, being apartments, townhouses, and detached for New South Wales. You can see this is a boom, weakness, drama with the crisis, bit of a recovery. But as you can see here, we're doing okay in terms of the detached housing market. The greenfield housing market is doing okay. It's turning over all right, and demand is gradually improving. It's not fantastic, but in terms of it ticking over, it's a pretty good context there. But having said that, the context for our total construction value and total construction numbers has actually fallen. It's fallen by about 13%, and the major reason for that is apartment and townhouse construction. You know, there's just nothing happening in that area. The value of construction in that particular area has plummeted again by about 56% compared to the previous years. So basically, there's no investors out there buying. It's very hard to get development finance. Land values are too high to try and make that kind of stuff stack up. It's very difficult to make things work in that particular area, which means it's very difficult for those guys, commercial construction guys who are also trying to build medium density residential. There's very little happening within the region in that respect. So we've got a very disparate housing construction context there. Nothing happening in medium density or higher density, or very little, but the detached housing market around Maitland and so on and further up there, obviously it's benefiting from the employment growth, etc. in the Upper Hunter. It's benefiting from having land supply in that particular area, part of the world, and it's turning over okay accordingly. So I'd expect that to carry on going forward here, but at the same time I wouldn't expect the apartment townhouse construction context to change overnight either. So, to pull that together, again, so we've gone from a bit of a managed slowdown, a purpose managed slowdown from the Reserve Bank, to wariness about this tilting. Effectively, we've got really strong growth in a narrow band of sectors, but we've got a broader range of sectors there, some of which are facing some serious headwinds. And the trouble is that you don't have to push those much to be tilting things over. It's a delicate balance. And so the risk is that it's a milder situation here, but we've definitely had a slowdown. The Reserve Bank are wary of too much cooling, which is why they've stimulated recently. We have momentum in regions, resources, and supporting infrastructure. That's not going to go away fundamentally. We've still got more further to go. Even in the face of a crisis, it'll probably put a delay and a lag as we had before. But fundamentally, the story's still very strong there. But there's more evidence coming through that we've got serious economic headwinds, and they're taking a toll on the region now. We're getting the evidence coming through that parts of manufacturing under a real stress within the region. Tourism isn't exactly flying. Retail has been struggling, and construction is a bit of a difficult context as well. So looking forward, in the absence of a GFC, we'd expect basically the Reserve Bank to be tinkering with interest rate policy just to make sure that the weak sectors don't get too weak and drag everybody down. But at the same time, they don't want to enable the resources sector to get too hot in the terms of trade benefit to stimulate the economy. So they're playing that game of just tapping things and trying to get it balanced. Of course, cutting interest rates means they're trying to boost retail and housing in particular, but that doesn't remove the context in which they're actually looking for structural change. So in some respects, those industries that are really facing major headwinds, that the Reserve Bank isn't going to change that context. In fact, they just see that as structural change. With a GFC, things change, of course, another GFC. So we would get a stall in resources investment, unlikely to change that context forever, but for a period of time. We'd expect the dollar maybe to fall and the terms of trade to fall. It's going to fall a little bit anyway, the terms of trade, but it'll fall a little bit more. But we would get huge stimulus again. And the positive story about that, of course, is in either scenario of those. We're very fortunate in this part of the world that they have the Reserve Bank that has the capacity to bring stimulus. They're not already shot all the ammunition that they have. They do have ammunition to spend. And likewise, from a fiscal point of view, the government, federal and state states harder, but from a federal point of view, they can stimulate again if they need to. So be it little or a lot, at least we're in a fortunate position in a global context. Thank you.